Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveney, and today I wanted to talk about a recent podcast I recorded with Jamie Bateman and Mark Podolsky. Jamie's podcast, Abundance to Adversity, took it on a little sidecar where we were talking about different investing strategies. And it was a debate on note investing versus land investing. And for those that know me, I love to debate people. I love to go back and forth and challenge people's investment, their investment thesis, as well as have people challenge mine, because I like when I get challenged because it drives me to want to do better. So for those that do not know, Jamie Bateman, who used to co-host the Good Deeds Note Investing podcast, which is what this turned into, also a note investor. Mark Podolsky runs Land Geeks, a very well-known, very well-respected individual in the land investing space. Teaches a lot of people on how to buy land to turn around and then sell or finance. So we had really great discussion that I'm going to just talk about and give my opinions on the different types of investing for note investing and land investing, and kind of why I lean towards one or the other, and why Mark, goes back and forth as well. So we did talk about the pros, the cons of each, and for note investing, I think everybody out there knows it can be a conflict-oriented business is one. Second is there's a lot of compliance in dealing with consumer protection laws and understanding that we're dealing with owner-occupied homes. So there's a lot that you have to stay on top of. And not only with that compliance side of things, there's the aspect of, potential litigation, because things could go wrong. Where on the flip side, when you are investing in land, you typically do not deal with those consumer protection laws because it's not owner-occupied property. Typically do not run into legal issues, and it's usually less conflict-oriented. And what I mean by that is if a borrower on a piece of land does go into default, they typically will not be fighting for it. They will typically either give you cash for keys back or let it go to foreclosure. But when you look at it from that perspective, there's also cons that can go between each investing side as well. In regards to on land, if you do take it back, land is typically less liquid than real estate, meaning that if you have a property, there's typically more buyers for a property than there are for a piece of land. Land typically has a higher default rate than a home does. Typically, there's less recourse on the land side of things than there is on a home. And land valuations typically have greater standard deviation compared to homes, meaning land prices tend to fluctuate more up and down than homes do. So from that standpoint, if you have a property, or if I have a borrower who goes in default, the pricing, again, without seeing the inside, which could be destroyed, but that value of that home typically stays fairly consistent, where land is, more variable to fluctuation in pricing. And if there's any type of softening in markets, typically you'll see it in land valuations first because it's not a necessity. And you'll see typically higher defaults in land because, again, it's not a necessity. People need to put food on their table, pay for their car, pay for their house if they have one, or pay their rent. They have to pay to live somewhere. If you have a vacant piece of land, then typically, it's something you're okay with losing, not really hurting you from that standpoint. But with that being said, as I go back and forth kind of on the ping pong match on one versus the other, Mark brought up some really good points about profitability, and the returns on land, when done properly, are exceptional. There's land that can be bought for a tax sale or off market, or somebody in distress. You might pick up a piece of land for $10,000 or $20,000 and then get somebody to put $5,000 down, seller finance it and collect the payments, and have great returns of 30 to 100%. Rarely is that the case in note investing. Now, that can be done with land, that you make those big returns, but it's usually in the smaller chunks. Meaning, I could buy a note for $200,000 and make 20% on it, which is, let's just say $40,000. Make $40,000 on the land. You have to have multiple pieces of property. Probably not going to be on one piece. Now, there's the possibility that yes, it can be, but it typically takes more work, more effort, and a higher quantity than it does on the mortgage note. Now, because it takes more quantity, people think, oh, it's harder, but it's got a lower barrier to entry compared to note investing. Note investing in today's environment, I'd recommend people start with, if you're going to do it on your own, a minimum of $50,000, where I know people with note investing can start with as little as $5,000, $10,000, or $15,000. Now, listening, you might get excited and say, oh, I want to go do land investing. Or I want to go buy land at tax sale or on market land. Comes my Boston accent, which is great. But just realize, what's the competition factor? Probably a lot more competition in that land space than there is on that note space. And I'm probably going to go off tangent right now a little bit as we talk about mortgage note investing, because one of the things that I am definitely starting to see is the number of people who are shying away from mortgage note investing. And to me, I love it. Now, why do I say that? Well, we have a large database of investors, and I have a good amount of people I'm connected with in LinkedIn. And one of the things that I do every day is that I started to do is I send out 30 messages to people. 10 of them are in our database in my CRM system, 10 connections on LinkedIn who may not be in my database, 10 conversations with people on websites like Bigger Pockets or other places. And these were people who were interested in notes 3 to 5 years ago. I reached out and said, hey, I haven't heard from you in a while. Wanted to check in. Are you still investing in mortgage notes? And the number of people who were investing previously to today, based off of the sampling that I have, is about 20%. So let that sink in. So if there was 100 investors 3 to 5 years ago, only 20 today. Now, why is that the case, Chris? Well, it goes back to another podcast I just recorded about the New York Fed and how the number of delinquencies is at all-time lows. When delinquencies are all-time lows, number of non-performing assets are lower. Non-performing loans have gotten a lot more expensive. People were used to paying 30, 40 cents on the dollar and having a lot of wiggle room in regards to, oh, I make a mistake, I'm still covered. Today, those prices are 50, 60 cents, essentially plus on the dollar, and your wiggle room is less. So you have to be very efficient how you manage and be able to spend the time where previously, I could work another full-time job and kind of just check on notes here and there because time is much of an essence because I've got this thing at such a great discount. Today, you have to be on top of every single asset every single day, which for those that don't know, it's Seveney. We have in-house management who manages assets. And at any point in time, we have an operations and myself also who make sure we stay on top of our assets. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. So I mentioned that because, go back to the land versus mortgage notes, we're starting to see a lot of competition in the land because there was a lot of money made over the last 5 years in land. And I know some people made great money. And I'm like, I wish I would have gotten into land at that point in time. But for me, it goes back to I try and stay focused on what we do. Mortgage notes and staying with the performing and non-performing, backed by property. The land side is something that I think is a good business model, but not my business model. That makes sense. So you started to see an increase in people on the land side and a less of people on the note side. So today it looks like, just like short-term rentals, people are diving in, making great money. But what's it going to look like in 2 years? What is the business model and is it sustainable? On the mortgage note side, the way we look at our loans and buy them with the significant equity and the equity coverage, we feel very confident that we can continue to buy loans. We see several $100 million a week in loans. Now that is performing and non-performing. We also have seen some other types of short-term lending opportunities that we have also done some within our portfolio, along with our non-performing loans as part of, again, that balanced portfolio. But if we do see home prices start to come down, how will that impact us? And for us, we think it will lower prices and bring in more inventory. Now, how will that impact the land investors? And again, it all depends on how much they paid, but most land investors are not familiar with how to deal with defaults. So what is going to happen when that occurs, or we start to see more defaults or drops in valuations, and people get stuck with those loans? So that will be an interesting case study to see. One of the things that, interestingly enough, and again, I'm going to go off tangent here for a second, is seller financing. And we wrote a whole another podcast on seller financing. I'll just briefly give a little synopsis of what that's going to cover. Is starting to see a lot of people do seller financing, not qualifying the borrowers and getting themselves in trouble. And on both ends, on the lender side, but on the buyer side, I'm also seeing people who bought seller finance properties where the lender financed it, put a tenant in there, and now all of a sudden need a $10,000 roof, a $20,000 sewer line pipe broke. And we'll talk more about this on another episode. But even though they have a renter in there and things are going well with the rent, they don't have adequate cash reserve. The lender did not underwrite them and gave them little down payment to put in, or they took all their money for down payment. So people were buying loans without flexibility of any type of repairs because they had the FOMO. I'm starting to see stories of people who are now what do I do? And they don't have the equity in the property that they thought, because they overpaid as well, because they thought I can overpay for seller financing, and we're going to start seeing faults there. But that will be our next step. Back to the land versus mortgage note debate. At the end of the day, both of us were doing the same thing. Just it's about how we get there. We buy loans on the secondary market and try and get the borrowers to reperform, or we performing loans backed by residential real estate. The business plan Mark has is buys land at a discount and then turn around and seller financed it out to other investors. Both business models, as I've mentioned, have their pros, have their cons. And for people getting started, I'll say go to land, because that way there's less competition for me in the note space. But it really depends on what your goals are, how much money you have. And if you want to start with 5 to 10,000, you could do partials on a note, or you could do land and just understand the process. If eventually you want to get into the note side on the residential side, I think you're better off going into that aspect, because there's a lot to learn about how to deal with the servicer, how to deal with state laws, understanding the laws, how to deal with attorneys, how to manage attorneys, how to manage a servicer, how to go through a defaulted loan. First time I went through a defaulted loan, yeah, it was scary, but you also have to make sure you don't have an ego and ask questions and understand that you don't know what you don't know. So I would ask attorneys, hey, this is my first time doing a foreclosure. What's the next steps? What's the process? But in the same token, I would do a lot of research that's out there. For example, usfn.org provides tons of content about timelines and matrices on foreclosure that you can understand and read. So then by asking the right question and saying, tell me how this works, ask the question, it's my understanding that we'll send a demand that's good for 30 days. And then after that, we'll file the complaint. And within the complaint, that process might take 6 months. is there going to be a mediation, or typically what have you seen lately for the timing of if it's not contested? So you've provided a little bit of information that shows you have some education. But I hope people found this episode of the notes versus the land notes interesting and just another option for people out there. As a note investor, I invest in other things as well outside of my portfolio. I have rentals. My wife invests in the markets, not invest in GameStop. But there's ways out there. There's more ways to make money out there. And the one thing I would tell anybody as the last piece of advice I'll give on this episode is do what fits you. Don't try and be the round peg and fit yourself into the square hole. Now, find what round peg, find that round hole. For me, it was the non-performing and performing mortgage note space backed by property. That's what I love to do. I also love other aspects of real estate. I loved building commercial properties. I enjoyed multifamily building. I don't mind owning rentals, but it's not my preference of things. So everyone has a different preference. At the end of the day, there's many ways to make money in this world and ways to create wealth. We try and simplify it, break it down, and provide you avenues for where you can go out, go learn about this. So hope you enjoyed this episode of Creating Wealth Simplified. And as mentioned, you can go to Jamie Bateman's episode of Adversity to Abundance and listen to Mark and myself. We'll also leave a link in the show notes. So take care, everyone. Thanks for watching. Enjoy the rest of your day. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.